The screen says gold is at $2,650. Silver is sitting at $32. These are the numbers your broker shows you. These are the numbers CNBC flashes every hour. These are the numbers the financial media wants you to believe are high, elevated, maybe even a bubble. But while you were watching those comfortable, manageable numbers, while you were reading articles about profit-taking and healthy corrections, while the mainstream narrative was telling you that precious metals have peaked, Goldman Sachs, one of the most powerful banks on the planet, quietly released a report that changes everything. They didn't hold a press conference. They didn't send it to CNBC. They published it in a restricted client memo, a document meant for sovereign wealth funds, billionaire family offices, and central banks. Not for you. But the number leaked. And when you see it, you'll understand why they wanted to keep it quiet. Goldman Sachs is projecting gold at $5,000 per ounce. Not in 50 years. Not in some fantasy scenario. Within the next major crisis cycle. And they're not guessing. They're not speculating. They're warning their wealthiest clients to prepare. But here's the detail that should terrify every investor who ignored precious metals. Here's the detail that the media is refusing to discuss. Here's the detail that makes $2,650 gold and $32 silver look like the opportunity of a lifetime. If gold goes to $5,000, silver doesn't go to $60 or $80. Silver goes to $180, maybe higher. This is not my number. This is the mathematical consequence of the gold to silver ratio collapsing under the weight of industrial demand, monetary chaos, and supply destruction. Goldman Sachs just rang the alarm bell for gold, but they're not telling you about silver. They're not explaining what happens when the ratio breaks. They're not warning you that the move in silver will be exponentially more violent than the move in gold, because they need time. Time to position, time to accumulate, time to exit their short positions before the stampede begins. But the warning is out. The number is public, and the implications are catastrophic for anyone holding fiat currency. In this investigation, I'm going to expose exactly why Goldman Sachs sees $5,000 gold. I'm going to walk you through the 3 converging crises that make this projection not just possible, but inevitable. I'm going to show you the gold to silver ratio, the historical pattern that has predicted every major breakout for 5,000 years, and why it's about to collapse from 80 to 1 to 30 to 1. And I am going to prove to you, using simple math and supply-demand fundamentals, why silver at $180 is not a fantasy. It's the logical endpoint of a system that has run out of options. Goldman Sachs is telling their billionaire clients to buy gold at $2,650 because they see $5,000. I'm telling you to buy silver at $32 because you'll see $180. One is a safe haven, the other is a rocket ship. This is the story of the greatest wealth transfer in modern history. It starts with a warning Goldman Sachs never wanted you to see. Number 2, the 3 horsemen of $5,000 gold. If you just watched number 1, you now know that Goldman Sachs has issued a $5,000 gold projection. You know this wasn't a public announcement. It was a private warning to the world's wealthiest investors. But now we have to answer the question everyone is asking. Why? What does Goldman see that justifies nearly doubling the price of gold from here? In part 2, I'm going to expose the 3 converging crises that Goldman Sachs has identified, the 3 forces that, when combined, create a perfect storm for monetary metals. Goldman Sachs didn't pull $5,000 out of thin air. They built a model based on 3 collapsing pillars of the global financial system. I call them the 3 horsemen of $5,000 gold. Horseman number 1, central bank demand. For 20 years, central banks were net sellers of gold. They were dumping their reserves, swapping gold for treasury bonds, convinced that fiat currency was the future. But something changed in 2010, and it accelerated in 2022. Central banks stopped selling. They started buying aggressively. In 2023, global central banks purchased over 1,000 tons of gold. That's the highest level in 50 years. China bought, Russia bought, India bought, Turkey bought, Poland bought. Even small nations that never cared about gold are suddenly stockpiling. Why? Because they see what's coming. They see the dollar weaponized. They see sanctions. They see freezing of reserves. They see the end of dollar dominance. And they're preparing for a world where gold, not treasury bonds, is the ultimate reserve asset. Goldman Sachs has modeled this demand. If central banks continue buying at this pace, they will absorb 20% of annual gold production. That removes a massive chunk of supply from the market. And when governments compete for a finite resource, price becomes irrelevant. They don't care if gold is $2,000 or $5,000. They care about securing it before their rivals do. This is the first horseman. Sovereign demand. It's structural. It's relentless. And it puts a floor under gold that can never break. Horseman number 2, the debt spiral. Global debt is now $315 trillion. That's governments, corporations, and households combined. The interest on that debt at current rates is $12 trillion per year. To put that in perspective, the entire global economy produces about $100 trillion in GDP. We're spending 12% of all economic output just to service debt. Not pay it down, just service it. This is mathematically unsustainable. There are only two ways out. Option 1, default. Governments declare bankruptcy. Bondholders lose everything. Chaos ensues. Option 2, inflate. Print money. Devalue the currency. Make the debt easier to repay in nominal terms, but destroy purchasing power. Every government in history has chosen option 2, and we're watching it happen in real time. The Federal Reserve paused rate hikes, but they haven't stopped printing. The European Central Bank is monetizing debt. Japan has been doing it for 30 years. China is quietly expanding its money supply to prop up failing banks and real estate. This is the debt spiral. The more debt you have, the more you have to print to service it. The more you print, the more inflation you create. The more inflation you create, the more people flee to hard assets. Gold benefits from this directly. It's the anti-debt. It has no counterparty. It can't be printed. It can't be debased. When trust in fiat currency collapses, gold is the only universally accepted store of value. Goldman Sachs sees the debt spiral accelerating. They see deficits exploding. They see central banks trapped between inflation and insolvency. And they've priced in the only logical outcome, a flight to gold that pushes the price to $5,000. This is the second horseman, the death of fiat currency through money printing. Horseman number 3, geopolitical fracture. The world order that existed from 1945 to 2020 is dead. The era of American hegemony, dollar supremacy, and globalized trade is over. We're entering a multipolar world, a world of blocks, a world where nations choose sides, a world where economic warfare replaces military warfare. Russia was cut off from SWIFT. Their dollar reserves were frozen. That sent a message to every country on earth. Your reserves are not safe. If you anger Washington, they will take your money. So what are countries doing? They're de-dollarizing. They're trading in yuan, in rupees, in gold. The BRICS nations, Brazil, Russia, India, China, South Africa, are building an alternative financial system. And at the center of that system is not the dollar, it's gold. Goldman Sachs sees this fracture accelerating. They see trade wars. They see sanctions. They see the dollar's share of global reserves shrinking from 60% to 50% to 40%. And as the dollar loses its monopoly, the asset that replaces it is gold. This is not about the end of America. This is about the end of dollar exclusivity. In a world of competing currencies, gold becomes the neutral referee, the one asset that every nation trusts because no nation controls it. This is the third horseman, the geopolitical reset, and it's the most powerful driver of all. Now let's do the math. Let's combine these three forces and see where they take the price. Central banks are buying 1,000 tons per year. That's roughly 32 million ounces. At $2,650 per ounce, that's $85 billion of annual demand. If gold goes to $5,000, that same tonnage is worth $160 billion. The demand doesn't change. The price adjusts to reflect scarcity. Global money supply has expanded by 40% since 2020. That's $30 trillion of new currency created out of thin air. If gold is supposed to be a store of value, a hedge against currency debasement, then its price should reflect that 40% expansion. $2,650 times 1.4 is $3,710. But that's just catching up to the printing that's already happened. If they print another 20% over the next 3 years, which they will, gold needs to be at $4,450 just to maintain its purchasing power. And geopolitical demand is the wild card. If just 10% of global reserves shift from dollars to gold, that's $1.5 trillion of buying pressure. The entire gold market, all the gold ever mined, is worth about $15 trillion. A $1.5 trillion inflow would move the price by 10%. But if 20% shifts, if 30% shifts, the price doesn't go up linearly, it goes parabolic. Goldman Sachs has run these scenarios. They've modeled conservative, moderate, and aggressive cases. In the conservative case, gold hits $3,800. In the moderate case, $4,500. In the aggressive case, $5,000 or higher. They're telling their clients to prepare for the aggressive case because the conservative case assumes the system holds together, and the system is not holding together. So here we are, three horsemen, central bank buying, debt spiral, geopolitical fracture. Each one alone would push gold higher. Combined, they create a supercycle. But if this is all true, if Goldman Sachs is right and gold goes to $5,000, then we have to ask the next question. The question that Goldman is not answering publicly. What happens to silver? In part 3, I'm going to show you the gold to silver ratio, the oldest, most reliable indicator in precious metals. I'm going to walk you through the math that proves silver will not just follow gold, It will outperform gold by a factor of 3 to 1. And I'm going to explain why $180 silver is not the top. It's the floor. The warning from Goldman is just the beginning. The real story is what they're not telling you. Part 3. The ratio collapse to $180. If you've been with me through parts 1 and 2, you now understand why Goldman Sachs sees $5,000 gold. You understand the three horsemen: central bank demand, the debt spiral, and geopolitical fracture. But now we have to talk about silver. Because if gold goes to $5,000, silver doesn't just tag along for the ride. Silver explodes. And the key to understanding why is a single number that has governed the relationship between gold and silver for 5,000 years. It's called the gold to silver ratio, and it's about to collapse. The gold to silver ratio is simple. It's the price of gold divided by the price of silver. Right now, gold is $2,650. Silver is $32. Divide 2,650 by 32. You get 82.8. That means it takes 82 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged around 50 to 1 over the long term. In ancient Rome, it was 12 to 1. In the 1800s, it was fixed at 15 to 1 by law. In the 1980 spike, it briefly touched 15 to 1. In 2011, it dropped to 30 to 1. Right now, at 82 to 1, silver is historically cheap relative to gold. It's undervalued by almost any measure. And when the ratio is this stretched, it doesn't stay stretched. It snaps back violently. Here's why. Gold and silver are both monetary metals. They've been used as money for millennia, but silver has an additional role. It's also an industrial metal. It's used in solar panels, electronics, batteries, medical devices. It's consumed, it's destroyed. Unlike gold, which sits in vaults forever, silver disappears into products that get buried in landfills. So silver has two sources of demand: monetary demand, like gold, and industrial demand, which gold does not have. When monetary demand surges, as it will when fiat currencies collapse, silver gets hit with a double wave. Investors buy it as a gold alternative, and industries panic by it to secure supply. This dual demand is what causes silver to outperform gold in every major precious metals bull market. In 1980, gold went from $200 to $850, a 4 times move. Silver went from $5 to $50, a 10 times move. In 2011, gold went from $800 to $1,900, a 2.4 times move. Silver went from $10 to $50, a 5 times move. Silver always moves faster and further than gold. Now let's apply this to the Goldman Sachs projection. If gold goes from $2,650 to $5,000, that's an 88% increase, a near double. If the gold to silver ratio stays at 82, silver would go to $61. Well, that's the baseline. But the ratio never stays stretched during a bull market. It compresses. Let's say the ratio drops to 50 to 1, the long-term historical average. Gold at $5,000 divided by 50 equals $100 silver. That's a 3 times move from today's price of $32. But what if the ratio drops to 30 to 1, like it did in 2011? Gold at $5,000 divided by 30 equals $166 silver. That's a 5 times move. And what if we see a true mania, a 1980-style blow-off top where the ratio drops to 28 to 1? Gold at $5,000 divided by 28 equals $178 silver. Round it up, $180. That's a 5.6 times move. Goldman Sachs is not talking about these numbers. They're not modeling silver. Why? Because their clients already own gold. They're institutions, sovereign wealth funds. They deal in size. They can't move in and out of silver without distorting the market. Silver is too small, too volatile, too dangerous for billion-dollar allocations. But that's exactly why silver is the better opportunity for you. The small size of the silver market is not a bug. It's a feature. It means that when the demand wave hits, the price doesn't just rise, it explodes. Let me give you a scenario. Let's say 1% of global stock market wealth decides to move into precious metals. Just 1%. Global stock markets are worth about $100 trillion. 1% of that is $1 trillion. Now let's say half goes to gold, half goes to silver. That's $500 billion into each. The total value of all the gold ever mined is about $15 trillion. $500 billion is 3.3% of that. It would push the price up, but it's absorbable. The market is big enough to handle it. Now look at silver. The total value of all the silver available for investment, excluding industrial stockpiles, is about $50 billion. $500 billion trying to squeeze into a $50 billion market is a 10 times demand surge. The price wouldn't go up 10%. It would go up 500%, 1,000%, maybe more. This is the leverage of silver. The market is so small that even a modest shift in capital allocation creates a supply crisis. And supply crises don't resolve with a 20% price increase. They resolve with a 300% price increase or a 500% price increase, whatever it takes to destroy demand and attract new supply. But here's the trap. New supply doesn't come fast. Silver is mostly mined as a byproduct of copper, lead, and zinc. If the price of silver doubles, miners don't suddenly produce more silver, they produce more copper. Silver is just a bonus. The supply is inelastic, so when demand surges and supply can't respond, the only variable that can adjust is price. And it adjusts violently. This is why I'm telling you $180 silver is not a dream. It's the math. If gold goes to $5,000 and the ratio compresses to 28-1, which is well within historical norms during a mania, silver hits $178. Call it $180. Goldman Sachs is warning their clients about $5,000 gold. They're telling them to protect wealth, to preserve purchasing power. But they're not telling them how to multiply wealth. Because if they did, they'd be talking about silver. We've covered the warning, we've covered the three horsemen, we've covered the ratio. But now we have to talk about the end game. What happens when the masses figure this out? In part 4, the final chapter, I'm going to give you the strategy, the timing, the traps to avoid, and the signs that the mania is here. Part 4, the endgame strategy. If you've made it through parts 1, 2, and 3, you now understand the full picture. You understand that Goldman Sachs sees $5,000 gold. You understand the three horsemen driving that projection. You understand the gold to silver ratio and why silver will hit $180 or higher. So now the only question that matters is, what do you do about it? How do you position yourself to capture this move? In this final part, I'm going to give you the playbook. The first thing you need to understand is timing. We are not at the peak. We are not even at the halfway point. Gold at $2,650 is still in the early stages of the move to $5,000. Silver at $32 is still at the bottom of the range that leads to $180. The mainstream has not embraced this narrative yet. Your neighbor is not talking about silver. CNBC is not running breathless segments on precious metals. That means we're still in the accumulation phase. The smart money is buying. The dumb money hasn't even woken up yet. This is your window, not to trade, not to speculate, to accumulate, to build a position that you will hold for the next 3 to 5 years as the supercycle unfolds. Rule number 1, buy physical metal only. I don't care what the ETFs promise. I don't care what the futures contracts say. If you don't hold it, you don't own it. The coming mania will expose every paper claim for what it is, a promise that can't be kept. When the squeeze happens, when premiums explode, when dealers run out of stock, the people holding SLV and GLD will learn a painful lesson. Physical metal is the only form of precious metals that is truly yours. Coins, bars, stored in your possession or in a fully allocated vault where you have title. Nothing else counts. Rule number 2, don't wait for a pullback. This is the mistake that kills more investors than anything else. They see gold at $2,650 and think, I'll wait for $2,500. They see silver at $32 and think, I'll wait for $28. Then gold goes to $2,800. Silver goes to $36, and they're still waiting. The truth is, pullbacks in a bull market are shallow and short. They exist to shake out weak hands. If you're waiting for the perfect entry, you'll wait forever. The better strategy is to buy now and buy again on dips. Dollar cost average. Build your position over time, but don't sit on the sidelines waiting for a crash that never comes. Rule number 3, allocate properly. How much of your portfolio should be in precious metals? The standard advice is 5% to 10%. That's for normal times. These are not normal times. Goldman Sachs is calling for $5,000 gold. That's not normal. When a major bank warns their wealthiest clients to overweight gold, you should be listening. I'm not saying put 100% of your net worth into silver, but 20%, 30%. If you believe the thesis, if you believe the system is breaking, then precious metals should be your largest position. Rule number 4, understand the mania psychology. There will come a time, maybe in 2 years, maybe in 5, when everyone is talking about silver. When your Uber driver asks you if he should buy. When Reddit is flooded with silver gain porn. When premiums are $30 over spot and dealers are sold out for months. That is the top. That is when you sell. Not before. Not when silver hits $100 and you think you've made enough. You sell when the mania is undeniable. When the final wave of dumb money is rushing in. But here's the hard part. You won't know it's the top in real time. You'll only know in hindsight. So you have to set targets. You have to decide now before the emotions hit what your exit looks like. For me, it's the gold to silver ratio. When the ratio hits 20-1, I'm starting to sell silver and swap into gold. When it hits 15-1, I'm out. Because that level has marked the peak of every mania in modern history. Rule number 5, ignore the volatility. Between now and $180, silver will have days where it drops 10%, It will have weeks where it drops 20%. The media will scream that the bubble has burst. The bears will declare victory. Your friends will tell you to sell. Do not listen. Volatility is the price you pay for asymmetric returns. If you can't handle a 20% pullback, you don't deserve a 500% gain. The people who make generational wealth in precious metals are the people who hold through the chaos. Rule number 6, diversify within metals. Don't just buy silver, buy some gold too. Gold is the anchor, the insurance policy. Silver is the speculation, the leverage play. You want both. A portfolio that's 70% silver and 30% gold gives you the best of both worlds. You capture the explosive upside of silver while protecting yourself with the stability of gold. Rule number 7, have an exit plan that's not fiat currency. When silver hits $180 and you decide to sell, what are you selling for? Dollars? If the reason silver went to $180 is because fiat currencies collapsed, then selling for fiat is selling for trash. The better plan is to swap. Sell silver. Buy gold, sell silver. Buy land, sell silver. Buy productive assets. The goal is not to get rich in dollar terms. The goal is to increase your purchasing power. Let's talk about the signs that the mania is starting. There are 3 indicators I watch. Indicator 1, premiums explode. Right now, premiums on silver coins are $4 to $6 over spot. In a mania, they go to $15, $20, $30. When you see premiums at 50% over spot, the squeeze has begun. This is the first sign. Indicator 2, mainstream media coverage. When Bloomberg runs a cover story on silver, when CNBC dedicates an hour-long special to the gold to silver ratio, when your parents call you asking if they should buy, the public has entered. The mania is in full swing. Indicator 3, institutional announcements. When hedge funds publicly disclose major silver positions, when billionaires go on TV and say they're buying, when ETFs report record inflows, that's the final stage. The smart money is preparing to exit. But the most important thing I can tell you is this. Don't trade this. Don't try to be clever. Buy, hold, wait. The Goldman Sachs warning is the starting gun. The move to $5,000 gold and $180 silver will take years. It will be volatile. It will test your conviction. But it will happen. Because the 3 horsemen are not going away. Central banks will keep buying. The debt spiral will keep accelerating. The geopolitical fracture will keep widening. Goldman Sachs is warning their wealthiest clients to prepare. They're telling them that $5,000 gold is coming. They're not telling them about silver. They're not explaining the ratio. They're not showing them the math. But you now know. You have the information that the billionaires have. You have the roadmap. You have the strategy. The question is, will you act? Or will you watch from the sidelines as the greatest wealth transfer in history unfolds without you? Gold at $2,650 is a warning. Silver at $32 is an opportunity. Goldman Sachs sees $5,000. I see $180. One is conservative. The other is life-changing. Choose wisely.